Alright, we finally got the confirmation that we have all been waiting for. It is almost certain now that we are going to push the terminal Fed funds rate beyond the 5.25% mark. Well, no thanks to the stubborn inflation, and that is why the S&P 500 went into deep red last week after Jerome Powell made a few pretty hawkish statements when he testified before the US Congress. But that's not the only major thing that happened, because last week more than $100 billion of market cap was wiped out from the US banks when SVB Group or Silicon Valley Bank reported a huge loss and was desperate to raise cash in order to survive. But in the end, they still collapsed. I break them down for you in just a bit, but first, the 10 to 2 year yield spread inversion has deepened once again after the market got the hint that the US Fed is going to continue hike more rates at a much faster rate, and that is why the short-term interest rates were boosted. And when the 2 year yield increased faster than the 10-year yield, that means we have more inversion. Pretty simple, right? We have also seen the VIX or the fear index spike up significantly, and the US dollar also picked up in strength after what happened last week. So for those of you non-US residents, you can definitely expect the US dollar to continue strengthen as the Fed continues to push the boundary of the terminal rates. And precisely because of that, I'll be releasing a video on how you can buy US treasuries via interactive brokers very soon, so stay tuned to that tutorial. And over on the oil prices, they declined last week after the hawkish statement from Jerome Powell, because if the high rates continue, people are going to spend less, economy will slow down, and that will cause an oversupply if there's any economic recession. So that was why the oil market was jittered a little bit last week as well. And last Friday, we also got the jobs report from the US BLS, and it came in hot with the non-farm payroll increasing 311,000 in February, far beating the widely expected 225k. But the saving grace for us is that unemployment rate actually increased to 3.6% as opposed to the estimated 3.4%, and the wage growth came in at plus 0.2% month over month, which was lower than expected, and it's actually the slowest growth since February 2022. So that was quite promising. Overall, the jobs report was somewhat a positive to the market, because the market actually got what they wanted to tame down the hawkishness of the Fed. But now let's talk about the elephant in the room. Jang jang jang. Last week, Jerome Powell testified before the US Congress for 2 days in a row. So here are some of the highlights that you should know. Number one, he said,
"The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated."
Now, in case you have not caught up yet, the current Fed fund rate stands at up to 4.75%. So by right, we should be hitting 5.25% after a 25 bits rate hike on March and another 25 bits rate hike on May. So 4.75 plus 25 is equal to 5.25%, right? So that was the previous terminal Fed funds rate, which means the rate at which the Fed will stop the hike of interest rate. But now that we had a strong series of strong CPI and PC inflation report on top of the strong jobs report, what Jerome Powell is saying here is basically telling us the 5.25% no longer means anything. We are potentially going up higher than it, which means it could be 5.5% or 5.75%, and even BlackRock's chief investment officer is saying there's a reasonable chance that the Fed will have to bring the Fed funds rate to 6%. But of course, those numbers are arbitrary at this point in time, because no one knows whether the US economy can still hold off for how long. And number two, Jerome Powell also said,
"If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes."
I mean, that just makes everything worse, right? Can you imagine front-loading the rate hikes to 50 bips on March and 50 bips on May instead? I mean, hypothetically, that would definitely send shockwave through the entire market, not just the US market, but the global stock markets as well. But overall, a strong Fed funds rate is not all bad, because there's always two sides of the coin for every situation. I mean, sure, the global economy will slow down and stocks and assets will devalue due to the risk-off behavior of investors, but the upside would be a stronger US dollar as well as a stronger short-term bond yield. So as investor, we can always capitalize on such opportunities, such as holding more US dollar cash or even invest in short-term US treasuries. But anyways, we still have 2 or 3 more very important data releases that the Fed will take into consideration before the next FOMC meeting on the 22nd of March, so stay tuned to that. Quick pause, if you found these updates helpful, I would be very grateful if you can check out Interactive Brokers in the pinned comment down below. Start trading with the most reputable and well-regulated broker that allows you to trade fractional shares in the US for which many other stockbrokers don't offer. And the best of all, their fee package is easily one of the cheapest among all other stockbrokers. Thank you so much. Okay, back to the video. Now let's talk about the entire SVB collapse that happened last Thursday, which caused it to lose over 60% of its market cap in just a day. SVB is just a small little bank with about $10 billion market cap before what happened last week, but they play a very important role in Silicon Valley because they lend money to a lot of tech startups, VCs, which are venture capitals, and private equity firms, for which, if it's not obvious already, tech sector is a key component to the growth of the US stock market. So in that sense, SVB is not just another bank, if you get what I mean. So what happened? Well, to help you understand this better, just recall what happened to FTX, the crypto exchange. And when Bitcoin and Ethereum and other crypto assets and cryptocurrencies were declining, FTX still operated as usual, right? But when that decline became a full-on crash, investors started to withdraw money from FTX in masses, and that caused FTX to run dry and end up bankrupt. So same thing happens here to SVB, well, except SVB is not running a Ponzi scheme, they are a legit bank. And last week, they announced that they wanted to raise $2.25 billion by diluting their own stock after they booked a $1.8 billion of losses on the sales of their bonds. So I'm sure right now you all can relate. The US Fed raised a whopping 4.75% of interest rates from 0% all within 1 year. So what happens is the older bonds with lower yield becomes less attractive when all the newer bonds have better yield. So investors started to sell off their older bonds and at the same time started to withdraw from banks left and right. But in normal situation, banks usually don't mind that happening because as long as they don't sell the bonds from their books, they technically do not incur any losses accounting wise, and rightfully so. They technically don't have to sell any of because all of them should by right have enough regulatory reserves to cushion that impact. But this was not the case for SVB because first and foremost, they are just a small bank, so smaller cushion, and to make it worse, customers started withdrawing and withdrawing, which gave them no choice but to sell off the bonds for cash and book the losses. So now you can imagine investors are fearing this could happen to other banks of all sizes. So that fear spread so quickly and the US banks lost over $100 billion worth of market cap in just a day. And of course, what happened next? They announced that they are closing their operations last Friday, and it is currently being taken over by the US FDIC, which insures the customers up to $250k US dollar only. And I believe many of their VC firms or tech companies that bank with them will definitely be affected by this crisis. But anyway, should you be concerned about all of this happening? Well, as far as my research goes, this shouldn't come as a surprise at all because SVB has been piling up their unrealized losses from the sales of their bonds and securities, which was actually known to the public through its earnings reports. So in hindsight, investors should have seen this coming from a mile away when a bank starts to realize their bond losses in order to raise cash, because generally any banks that raise cash will raise a huge red flag. So in my 2 cents worth of opinion, what happened last week was a reminder to all investors that this is a potential scenario that all banks may face if the economy takes a turn for the worse. So inevitably, there will be some realignment of the future outlook and share prices as well. So upcoming important dates for this week, strap your seatbelt, ready for liftoff, because boys and girls, we got some hot CPI inflation data coming in on Tuesday. 1 month ago, we got cocky, and just when we think inflation is plunging down, it came in higher at 6.4% instead of the expected 6.2% year-over-year growth. So this time, the consensus is forecasting a 6.2% growth again for the month of February. So for what it's worth, anything above 6.2% will possibly be ugly, to say the least. Yep. One word sums it all, I suppose. There are also a few more macro data updates like the retail sales data and PPI on Wednesday, so rest assured, as long as you are subscribed to the channel, you will be able to get the quickest update on Monday, same time. Thanks for watching, have a great week ahead, and I will see you in the next one.